We've had 2 or 3 extremely turbulent times, weeks for banks in terms of the share price. How do you think you'll look back at this time in 4 or 5 years from now?
Oh, well, it's a pleasure to be here again, Francine. Thanks for having me, and good morning, everybody. 4 or 5 years is a very long time to try to answer that. But look, the context is difficult. I think you've mentioned quite a number of key elements in your introduction, the interest rate environment, which is very important for us, the general macro environment, which is not necessarily supportive, and the need to make very significant adjustments for many banks in a relatively unsupportive market environment like we've seen in Q4, Q1. And of course, at times like this, there is overreaction. There's always a risk of overreaction. Most banks are trading below book.
Overreaction by shareholders.
Yeah, reaction by the market. And you get extreme movements on the basis of relatively minor piece of news because there's a lot of uncertainty. There is regulatory uncertainty. There is there's no great visibility on what our capital base is going to be and what the future requirements are going to be. You get uncertainty generated by potential fines like you've seen on Deutsche this week. And all that together creates a very fragile situation. So what we can do in that environment is focus on what we control. And that's what we've been doing at Credit Suisse. Certainly taking the cost base down, because in an environment like that, you have to create operational leverage. You have to lower your break-even point so that you're a bit more in control of your destiny and less dependent on market movements, which means, of course, a lot of cost cutting, a lot of de-risking, a lot of deleveraging,
right,
which is what we've been doing, cutting risk, cutting leverage, cutting cost. But at the same time, investing in the future. And I gave the numbers yesterday. If you wish, in the first half of this year, we reduced RWA by 23 billion in the investment bank and the restructuring unit, but we reinvested 17. And that's not very visible yet, but we are really shifting capital from activities where it generates 6 or 8% to activities where it generates 20%. And that's, over time, that's going to improve the economics.
But what do you think shareholders, and I know you hate talking about worst case scenario, and it would be unfair to push you to talk about worst case scenario, but what do investors really fear? Do they fear capital raising, like you alluded to? Do they only fear profitability erosion and the scrap of dividend?
I think it's all of the above. I think there is a lot of doubt, fundamental doubt about is there a viable business model that covers its cost of equity, where return on capital covers the cost of capital. That's the big question. And then you have all the components of that, the numerator, the denominator, the uncertainties on the level of capital. You've seen at Q2 that some of the leading banks in the world generate 8% return on equity. That's not enough. So there is that question, which really makes banks a bit difficult to, not really investable. As a sector, a lot of fear, then effectively dividend, and really the kind of low interest rate environment, which in our case, frankly, we've been able to manage. If you look at our numbers, actually our net interest income has increased constantly. We've been able to manage through that, but that's not the case for all the banks, and it creates a cloud over the sector.
But so what again, it makes banks very vulnerable, right? Is there a space for EU investment banks, or do you have to make sure that shareholders understand your strategy, which is a little bit different to being an investment bank?
Yeah, I think it's more of a latter. And we're very clear on what we want to be, on what we don't want to be. Certainly, I was with a client just before coming to this meeting, and they were telling me that, look, the fact that you've clarified actually what products you're in and what you're not in your investment bank makes our life easier, because we know how to deal with you on that basis, and you cannot be everything for everybody, and it's good that there is that clarity.
And you think your strategy has been understood?
Oh, I think you can't ask me that. You have to ask people who listen to us. They'll tell you, no, look, I think it's been understood. Of course, there is always a lot of skepticism, and that's fair on execution, because there's a lot of execution involved. But I think what we're trying to achieve is increasingly understood. Certainly, In the last month, our top 3 shareholders have bought more than 2 billion Swiss francs of shares, and that has driven the share price. You've seen the performance this quarter. So I think that after a very turbulent Q4, Q1, good stabilization in Q2, I think Q3 will be reasonable. Yesterday, I gave a few warnings on Q3, but fundamentally, it's still going to be a good quarter, good performance of the bank. Over time, it gets understood.
And how can you reassure investors that you don't need to raise capital? I ask you every time.
You ask me every time, and I always give you the same answer, which is that I will never say that, because I don't like to be a hostage to fortune. I always say, under most foreseeable scenarios and circumstances, we don't need to raise capital, but I cannot completely exclude that possibility, because that would not be wise. There are always extreme scenarios that take you to a different level. But I think we are at a comfortable level. Look, there was a lot of debate last year on whether we should raise capital or wait for certain events before raising capital. I made the choice of going early. And frankly, sitting at 11.8 today, I feel that it was the right decision that the board and the management made. When I want to provoke, I say I'm not smart enough to run a bank at 10.2%. Because to be able to do that successfully, you need to have perfect knowledge of the future and perfect execution, and I have neither. So it's good to have a buffer. Good to have a buffer, because then you can operate and you can manage for uncertainty. When you sail too close to the wind, you just amplify the volatility of your share price.
Do you think we'll get consolidation? Do we need consolidation in the European banking industry, and will we get it?
That's a very, I was interested by Mario Draghi's comments. I think he went on the record saying that there were too many banks in Europe. So it gives me the air cover to talk about that. I think if you look at Wells Fargo, you look at Bank of America, you look at JP Morgan. I was in my career personally involved in one of the largest mergers in America at the time, and those banks have been created largely through mergers. The thing with a merger is you get two benefits. You can extract a lot of cost. Cost synergies and cost cutting is really very, very significant, and you create a more diversified, more stable organization. If you wish, with the differential impact on JP Morgan's number of the same drop in equities, activities, or fixed income is disproportionate. They can absorb it much more easily. And clearly in Europe, that has not happened. And
do you believe Europe is overbanked?
I think it could, let me put it differently, I think it could benefit from consolidation. Yeah. It could benefit from consolidation. It would be a lot of upside. Because right now, every institution is trying to be on a very restrictive diet and shrink on its own. And I'm just arguing that that's much easier to do when you put two institutions together. That kind of slimming down and taking out cost and inefficiency. It's much easier to do. But it's I don't think it's a realistic option at this point in the industry
because of regulators?
Because from the moment you say too big to fail, the notion that you're going to create bigger banks is never going to be is not going to be viable, at least in the shorter term. If people think that banks are already too large, you can't increase your balance sheet. So that's an issue. But I think, without being partisan, if you look objectively at the banking landscape, I think there is room for consolidation.
What's your view on Deutsche Bank? I know you don't like talking about competitors either, but you must think about it, because there's again a snowball effect.
No, look, I can comment on the sector. I always believe, ultimately, that it's better to find a solution that allows everybody to move forward and do well. And really, I don't have a Schadenfreude. I don't rejoice at others' difficulties, because they affect everybody. You've seen yesterday that particularly RBS and us and Barclays were dragged down by the market reaction to the news on Deutsche. You saw the CDS going out. You saw all those disruptions are not helpful. Deutsche Bank is an old institution, a great institution, and I really wish them well. I hope that they come out of their current predicament.
Do you think these disruptions, these market disruptions, will last well into 2017, or are we nearing the end? And you mentioned, fines. I know it's difficult to see the end, but 6 months from now, 12 months from now, will it be largely fixed?
Well, I think the next 9 months are going to be difficult, because I cannot remember certainly in my lifetime, having an Italian referendum in October, a French election in April. Sorry, I skipped the US election. Italian referendum in October, US election in November, French election in April, and German election in the summer. That's a kind of redoubtable alignment of events. And I think it's going to create necessary...
And Brexit negotiations.
I forgot Brexit, yeah, which just happened. So I think it's one time in the cycle where, yeah, politics are going to play a big role. And you're going to... Right now, we've had low volatility, very low volatility for a while, but I think you will have spikes in volatility as a poll goes in this direction and people think that this candidate may or may not win. You're going to have that. And then you also have the drift towards populism in the political discourse, which I think will scare markets because you will see the likelihood that some people with pretty disruptive strategies or policies get close to power, and that's going to be unsettling for markets. So I think the next 6 to 9 months are likely to be quite choppy.
Tidjane Thiam, we have a chart looking at negative rates. Have central banks sowed the seed for the next recession? Or it's amazing when you think that the fact that actually 8 years on from Lehman, where we are.
Yeah, it's a very complex issue. I think the Economist wrote about it this week. I mean, everybody knows from a background of kind of insurance, etc. And demography has always been a big consideration, part of my thinking about the world. And clearly, I think that's becoming now clearer, but probably Mark Carney was one of the first to talk about it openly, but there is a clear link between demography and what's happening to interest rates. It's not just central bank policy. I think that's well established. There's been a kind of a glut of savings that has impacted the real interest rates. So you've got demography on the one hand, and that's not going to go away, and that's a very difficult problem. Unfortunately, there's a lot of very negative loops there, in feedback loops. If you have very low interest rates, your pension deficits increase. So that just makes the whole situation even worse. You can see that in Switzerland. You cannot make any money on the assets and the liabilities explode. And compounding that, you have a lost income, which really I'm surprised that that's not more discussed. You accumulate most of your pension between, let's call it between 40 and 55, and you have your maximum earning power. So the people who are 40 between 08, so let's call them born in 1968 and the next 15 years, will have an enormous pension deficit because they've made nothing on their assets, zero. So that's a problem. Then you get the distortions in asset prices that are linked to that, which was an explicit objective of QE, to drive asset prices up and push liquidity into the equity market and so on. But I've always asked the central bankers, what about the distributional effects of that? Right? The distributional and political effects of that are huge.
And what do they answer?
You have to ask them. No, because it becomes a political problem. Because in democracies, distribution is handled by parliament. Okay? Normally, that's how it works. And if you organize a huge transfer of wealth that is not sanctioned by parliament, it's going to lead to political issues. It's just the way it is. And that's exactly what happened. So if you're a debtor, you love this environment. You can borrow, you can issue debt at negative rates. It's fantastic. If you're a saver, you hate it. And there's even an argument that actually income inequality has also fed into the low interest rates because the propensity to consume is lower in higher income brackets. So that has compounded the glut in savings and the lack of consumption.
But how do you fix this? Do central banks need to step away from what they're doing? Do they need to recognize that actually they didn't look into it enough before going into negative rates? Or is it much more complex?
Well, the argument I've been making is that it's not just the central banks. You know, all those forces, whether it's demography, whether it's savings behavior, whether it's distribution of income in society, are not controlled by the central banks. So the solution is going to have to be broader than that and involve a proper political debate, particularly on the distributional consequences. This is why everybody comes back to this fiscal debate, because in the end it's about fiscal policy. It's about stimulating demand. and resolving some of those imbalances. So central banks can play a role in that. But I don't know. I think in the public debate, people like to go to simple answers. And so to blame everything on the central bank and say, well, they just have to raise rates, I think is overly simplistic. And it's not going to resolve some of the imbalances we're discussing here.
What would help your job, though, as a banking CEO?
Oh, if interest rates go up, no question. But you just have to see the share price reaction every time there is a whiff of interest rate going up, clearly. I think ultimately they will go up. I am absolutely convinced of that because the system can only survive ultimately if there is a normalization of interest rates. What I'm not able to predict is when it's going to happen or exactly by what mechanism.
Why has the Fed been so shy so far?
I wouldn't describe them as shy. I mean, they have a very sophisticated process of decision making. Certainly, we would welcome an increase in interest rates, and the market right now is pricing 100% probability by next June. So the market is telling you that interest rates will rise between now and next June. So, and I share that view. I think that's correct.
You were talking about choppy markets for the next 9 months.
Yeah.
What's your main concern? Where's the main headwind coming from? And I know we talked about political risk, but how do central banks?
It's really back to politics. I really think that the big cloud right now is the elections and the uncertainty attached to it. I mean, France and Germany play such a big role in Europe that clearly, if you have the two countries going for a major election at the same time, that creates huge uncertainty. And on something like Brexit, it has clearly an impact because you have the two camps, those who tell you should wait to know the outcome of those elections before you do anything, and those who tell you, no, you should start now. It's a big source of...
Does it affect your share price?
For us, not directly, but indirectly, yes. I mean, indirectly, yes, through decisions that are not made, through transactions that don't happen. Yeah, uncertainty is never very good for demand. So I mean, we're going to have to go through that and then see what happens. But conversely, you can also hope that once that's removed, things will get better and there is an upside there.
What does a Brexit mean for banks based here or banks with a lot of exposure to London and the UK in general?
Yeah, well, I think you saw before the referendum that most banks supported Remain. Now we've had a democratic vote and it's Brexit. I mean, I can talk about us. We had, since last year, when we announced the strategy, a plan to reduce our footprint in London. We have eliminated about 2,000 jobs in London at this point in the year. So our strategy was to de-emphasize London. Now, that being said, we are not very much impacted by the passporting issue because only 15 to 20% of the volume we do here would be affected by that. So we are relatively in a reasonable position on that. And fundamentally, one just has to wait because we just don't know what shape Brexit is going to take. There's a lot of speculation on when Article 50 may be triggered. And then, you know, between a hard Brexit, a soft Brexit, there are many variations of Brexit which can have an impact on the passporting and also on the free movement of people. So it's uncomfortable, but I think we have to wait until things get clearer.
Could Dublin be the new London post-Brexit for banks?
Well, we have, as you know, a big operation in Dublin. It was opened by the Irish Prime Minister, I think, in December. And we've transferred a lot of our prime services activity to Dublin. So we are well positioned and we have that optionality. We also have a big platform in Luxembourg, which is important for us. So we have a comfortable position. And we have also transferred a lot of jobs in Wrocław, in Poland. And we've been followed there by UBS, by Goldman Sachs, by others, which is also in the EU. So look, we are in a reasonable position to manage through the next phase.
How do you view risk overall? Yeah, I know you're cautious, and this was basically I guess, the premise of your overhaul. I see 8 minutes there. It's like, I'm not sure. I need 30 seconds.
It's not fair. How do I see risk? It's everything. It's everywhere. It's just, I trained in maths and in physics, and all that teaches you is that basically the world is just a big random experiment, and you cannot, you cannot come out of that type of training without a really strong belief in the randomness of things. And this is why you always get vague answers from me. When you try to nail me down on 4 or 5 years from now, you always get the same thing from me, which is waffle, because I know I don't know. Okay, and it's a fool who tries to make 5 years projection in a world that is so random, so random. So you cannot foresee the future. That is a futile activity. What you can do, and that's what quantum mechanics is about, is predict a range of futures. And then you can think through how you are going to cope with a range of future, and they have different probabilities, and then you define your risk appetite. If you wish, in other words, what probability of death are you willing to accept? So you try to minimize that, because it's not good to die. But that's how you. I mean, this is why I raise capital, because
right, straight away.
Yeah, because in life you should only worry about the bad outcomes. So the type 1, type 2 errors. You can raise capital and be wrong. You can not raise capital and be wrong. The other 2 outcomes you don't really mind, because when you're right, it doesn't matter. So if you raise capital and you're wrong, it's okay. If you don't raise capital and you're wrong, you die. So back to my probability of death, that's a very simple piece of thinking. If you're a reasonable decision maker, you don't go for that option, because why? I mean, the same way when before Brexit, people tell us 78%. We're fine because the market says 78% Brexit Remain wins. I said, well, 22%. I don't take 22% chances. Way too high. And 2 weeks before, we took risk down. We increased our hedging. And I said, this is like playing Russian roulette. It's 1 in 6. Do you play Russian roulette? No. So 22% is higher than Russian roulette. It's 1 in 5. So, sorry, just to take you through how I think about risk. Yeah. So that's how I make my decisions. Think about the outcomes. Think about the probabilities. Try not to get those wrong, because if the probabilities are wrong, then you are going to get. If your assessment is wrong, then you're going to get in trouble. So you need a lot of information to do that. And the other thing I really believe about risk is that it's so multi-shaped that really you should never run a company on one set of risk metrics. I transported that from insurance to banking, but always look at least 5 or 6 lenses. You get capital, you get rating agencies, you get regulatory capital. Regulatory, you just have to meet, because they'll close you down if you don't meet that. But you get rating agencies, you don't want to be downgraded. You get cash flow, which people, liquidity, which people always forget. Liquidity will kill you. And then you get market risk, you get op risk, somebody doing something crazy somewhere, and you have to look at all that, and you have to look at all that according to a broad range of metrics. I didn't like the VAR, when VAR was raining and everybody was just talking about VAR all the time, because that's the logic that tells you a river is 1 meter deep on average, but it's a 100-meter hole in the middle and you can't swim. So if you try to cross that on foot, you will die. You will die. So, sorry, risk is everywhere. You have to think about it all the time.
What's your biggest hope for Credit Suisse? Do you, and you've told me this before, but I wonder whether it's changed given what we've seen in the markets over the last months. You had said at the time that you just wanted to leave it in a better place that you found it.
Yeah, I said that. But look, the bank was created in 1856. It's really continuing that story. Making sure that in our DNA we have the right behaviors to really last and continue to do well, and serving our clients. I mean, really the best part of the job is to be with clients. What I did this morning is what I do as much as I can. They're exciting, they're interesting, they have ambitions, and actually to support them is quite a noble mission. That's something that I enjoy. I think most people at Credit Suisse enjoy. The pain we are taking, all the adjustments we are making have an end, and the end is to serve our clients. yeah, I love going to China and meeting our billionaire clients there, or anywhere in the world, or in Brazil, or in Africa.
And you're bullish on the emerging markets, still bullish?
Long term, yes, because they can only grow faster than the developed countries. Because if you know, I mean, I was born in the developing countries. The number of rivers that need bridges, the number of villages that need electricity, the number of places where there is no safe water and you need to put water, and the demand, the telecoms, the mobile phone, the productivity of the economy, the infrastructure, and the technology we have. So you have those huge needs, and you have the technology answer. So as soon as a country gets its act together, and you have a proper government, and you get the capital flowing in, and the productivity. Economic growth is about productivity of factors. The productivity comes and the growth comes. There is no way those countries, and on top of it, they have a positive demography. There is no way, medium term, those countries don't do well. Now, there is volatility. You have to be diversified because country A will blow up, country C will do well, and it's very hard. Back to my argument, you can't predict the future. It's very hard to pick winners. So you have a broad strategy, which is what we have in Asia and in other parts of the world. But on balance, in the medium term, it can only work. Yes, the Fed will raise rates. Yes, flows will revert. But long term, you have to look at the long term. Take a country like Indonesia, 250 million people, the needs for infrastructure, whatever they do, they grow at 4 or 5% anyway, which is a lot. It's about $1 trillion economy now and growing at 4 or 5%. And you have many countries like that. So
what about China? It's been eerily quiet on the markets on China. Is that a good or a bad thing?
Market is a strange animal. It doesn't seem to be able to focus on more than one or two things at any point in time. So, China used to occupy everybody. Now it's forgotten, but it's still 1.3 billion people and $10 trillion of GDP. So we've talked about it over time. I've never panicked about China. Through the years, I've always told you, look, it's gonna be okay. Yes, there will be volatility, but it's gonna be okay. And I'm in the same position. Yeah, people worry about the debt. Yes, the debt is a problem. But I think overall, again, the pockets of productivity gain are such that they're going to continue to drive forward. And you have this whole transition to the service sector, which you have quite a few companies are actually really going into. You have growth sector. What's happening is that the old economy is shrinking at about 1 or 2% per annum in China, and you get the new Chinese economy that is growing at 11%. And that's what produces the 5-6% that you see. And that every major economy goes through those transitions. The steel industry in the US disappeared and other things, and Facebook appeared. It's natural. It's nothing to worry fundamentally about. Healthcare is booming in China. The hospital sector is booming in China. The service sector is booming in China. Tourism, nobody even knows. I've heard any number between 80 million and 100 million Chinese went abroad last year. Well, it doesn't really matter, even if it's 80 million. It's more than any other country in the world. And people say they spend $200 billion abroad. Okay, that's more than the GDP of most countries in the world. You have an explosion of tourism. You have an explosion of leisure. They build more movie theaters every day anyway. So there are many sectors in that economy that are growing and are going to continue to drive the economic growth. So you've got investment in the environment, all these problems. We need to have cleaner growth. So people don't like change. The thing is, the country has changed a lot. It's going through more adjustment, and it will continue to go through a lot of adjustments. But what I see in China is a government that you want to stop me.
No, I don't. I mean, we could talk about China for an hour, which we don't have the time.
A government that as a correct diagnostic. If you read what they write, what the plenum of the Communist Party writes, they have the correct diagnostic. The need to shift from investment to consumption, it's there. The need to have a less manufacturing intensive growth. The need to pivot toward the service sectors. So it's an execution challenge. Now I contrast that with Europe. Do I need to say more? I mean, at least they have a very clear, articulated strategy. I always find it funny that people are so skeptical about the ones who actually have a right diagnostic, are trying to implement that. They may or may not succeed, but we'll see. Compared to places where we don't even have a clear diagnostic or a clear vision of what's going to happen. So I've always been comfortable with that type of risk, back to risk, because I don't think it's a risk in the long term. And for instance, Brexit has showed us that political surprises don't just happen in the emerging markets. So I think there is a lot to be said about perceived risk versus actual risk and how you can make money from the difference.
Tidjane Thiam, thank you so much for your time.